All right, go.
Welcome, ladies and gentlemen. My name is Neil Angel, coming to you from beautiful Greenville, South Carolina, and I am pleased to introduce to you today my special guest, Brad Etheridge with Business Transition Advisors. They are a company that specializes in working with business owners to transfer their company and with succession planning in the most tax-advantaged way, which just happens to be with employee-owned companies. So welcome, Brad.
Well, nice to be with you, Neil, and nice to speak to your group. We're going to do kind of a high level flyover here because there's a lot of moving parts to an employee stock ownership program. And Neil asked me just to do a high level explanation. So, with your permission, Neil, first of all, with the employee stock ownership program, it's not the perfect fit for every type of company, but if when it is a good fit for the specific company that your client may have, it's pretty hard to beat the tax advantages and the dollars that ends up in the pocket of the selling owner. And one more thing I like to point out very early on, Business Transition Advisors, the company that I work for, we are an ESOP, and we're one of the very few in the United States that actually, drinks the tea. So not only do we believe it to be a good solution, we are one. And that's one of the reasons why I went to work after 40 years in financial services, why I went to work with.
Yeah, I'm intrigued by your concept, and I've learned a lot of late in working with you about ESOPs and the advantages of using ESOPs over other options for selling an owner's company. And I'd be interested to hear more about the three options that business owners have and sort of the advantages and disadvantages of each of those options.
Yeah, absolutely, Neil. I mean, usually what happens is when somebody's looking for the ultimate succession, they're ready to walk away from the company and cash in. There's a few options. One might be selling to a private party or selling to a competitor. The second option may be selling to private equity. And the third is what we're going to focus on today is what if you sell the company to your employees. Now, that's not maybe as simple as you would think. When you sell it to your employees, I'm not saying that you look for your 5 or 6 people who helped you to start the company and say, look, I'm going to let you pay me off over time for the company, because most companies can't cash flow paying the new buyers, the new owners, and all the employees and have enough cash flow left over to pay the seller off in a reasonably short time. Now, if you have to collect the money for the company as the seller over 30 years, it just means you're taking all the risk of the company's performance and not being able to cash in. So, when you're looking at the options, the advantage to selling to the employees also is that you can avoid capital gains. A lot of my business owners I've worked with over the 40 plus years in financial services, may have started their company out with $1 million or so, if that, and either they took a loan out to cash in all their savings and they took all the risk, and now the company's worth 25, 30 million or more. And everything above their bases, that million is going to be subject to capital gains tax, as you well know, Neil, and state capital gains tax, which can be another 5 to 7% on top of the 20 on average of federal. So you're looking at losing roughly a third of whatever you sell the company for back to taxes. And with employee stock ownership properly designed, there is no capital gains. They can be deferred forever. And that allows you to actually put more money in the pocket of the seller. Now, the other thing that I've noticed in my years of financial services is that most of my business owners are successful because they don't have to answer to anybody else. They've taken the risk. They don't play well in other sandbox. And now all of a sudden, if you sell to private equity or you sell to a competitor, or even a private party, they're going to want you to hang around for a couple of years to keep the employees from panicking. And maybe over that couple of years, they'll pay you off. Maybe they'll give you a big chunk of money up front and then the balance at the end of 2 or 3 years, assuming the company hits those bogeys that were put into the financial package of what the company was selling for, which means you're sitting at a desk, but you're not really doing anything of value, and you can't help those key employees when they come walking down a hallway with a box of their personal possessions. And all you can do to help them is open their door. So An ESOP allows the seller who has all their DNA in the company to keep complete control over the company for as long as he or she cares to do so. And then after that can also stay on the board to make sure the company is there to protect those relationships with those long-term and for all the employees and to make sure the DNA of the company stays in place. So if I can do a really simple example, let's say we have a company that qualifies to become an ESOP, an employee stock ownership program. The employees are given out shares every year, and those shares are going to be based on the value of the company. They're not going to be taxed immediately because this is a qualified plan, just like a 401k or a profit sharing plan. As long as that money stays in that qualified plan, it's not taxable until they start taking out. And these are beneficial interest shares. They are not voting shares. So the employees can't get together and change the board of directors or change who's running the company. But as the company continues to grow in value, the shares that are distributed each year become more and more valuable. Great example, one of the largest ESOPs in the United States is a company called Publix Foods, a grocery store down in Florida and Southeast. And the reason they're so successful is they've got employees that they've got cashiers at $20 an hour that have over $1 million in their qualified account when they're ready to retire, because they all take ownership in that company very seriously. The more efficient they are, the more effective, the more pleasant. Walk into a Publix and ask where the restroom is, and somebody will guide you there. They just don't point down a hallway. The stores are cleaner and the employees are more pleasant because they know the better the company does, the better their retirement account. So that's, it gets all the employees rowing in the same direction. So if it makes sense to do an employee stock ownership program, it starts with valuing what the company's worth, a legal valuation. And we put that together for the client and say, here's what it is. And it involves having to get how many shares are actually going to be structured and how they want to be distributed. And how they're going to be distributed has a lot to do with what's in the best long-term interest of the company. Because, we want the company to be there to safely protect the employees for years and years and years in the future. So, like I said, there's a lot of moving parts, but what BTA does, Business Transition Advisors, is help to walk the proper company through those steps and execute. And then once the ESOP is set up, we stay around for a couple more years, unlike our competitors, to walk you through those important stages. And if the seller chooses to stay on in an active role for a period of time, they can still collect their salary and their bonus and their employee benefits. And quite honestly, that's a great thing because you're the one who made the company successful. Doesn't mean you have to be there 80 hours a week. But if you have your hand on the rudder, there's no reason that you don't collect your benefits, bonuses, and salary. And then eventually when you want to step away because you've got your people in place to run the company, you can still keep control by being on the board of directors and along with another person on the board of directors maintain control. And we explain on how that works. And if you grew the company over the 5 to 7 years or 8 years, which is about how long it takes for most of our owners to get 100% of the street value that they agree to for selling the company. Once that happens, if you have grown the company over that period of time, you can pick up another beautiful thing called warrants. And warrants are what happens when the company grows while it remains under your control. From what we call it the second bite of the apple. So you agree to a selling price of the company in the beginning. And when the company grows, assuming the company grows at the end of your last payment, when you received all your payoff for the agreed upon value of the company, on average, it's about 20% of the original value is paid to you in cash 90 days after you've received your last payment. And that's contractual, so it's not something that needs to go back and be negotiated against. But, think about it. If private equity or competition buys your company, don't expect a check from them if the company's doing better than 5 years than it is today. So it's one of the unique attributes of a ESOP.
Yeah, I know, Brad, you mentioned there were three options, and you mentioned the issue of control of the company as one of the issues that would perhaps lead someone to choose an ESOP option over the PE option. But
Yeah.
can you explain a little bit about what PE companies do and how they structure their deals and why this makes more sense from the standpoint of the owner, how they could come out ahead with an ESOP versus a PE buyout?
Well, if a private equity comes in, what they're going to do is, I mean, they'll pretty much, for the most part, give you what you're asking. If it's an inflated number and you don't hit those targets, they're going to claw it back. And I think a lot of people understand that. So if somebody really hates their company or doesn't like their employees and really wants to get out quickly, that may be the way to go. If there's a concern over the well-being of their employees, I'm not trying to make that sound like a bad person. Sometimes that's the way it works out. Or feels that the company is going to grow over the next 5 years, that's a good candidate for an employee stock ownership program. With either a private equity or a competitor, they're usually going to ask you to stay for a couple of years. They don't want to spook the current employees. But again, now you're there answering to somebody else. It usually, for most of my business owner clients that I've worked with over the 40 plus years in this business, it's not a good fit. They want to call the shots, and when you have somebody else purchasing you, you're no longer calling all the shots. But with an ESOP, you still have control over your company. So you're making those decisions on a daily basis, and you're there. Maybe it's with your succession team, maybe it's with your key person you're bringing in to replace you. You're reviewing their decisions in line with what you were looking for the company to do over a period of time. So again, it doesn't mean you're there 80 hours a week. You could be coming in once a week for a few hours and overseeing. You could be on a call like this. But at the end of the day, you maintain control. Nobody's going to tell you what you can or can't do with your company, with the exception of one thing that makes an ESOP very unique. Because this is a qualified plan, again, just like a profit sharing plan or 401k or an IRA, there's rules. One of the rules is there needs to be a trustee. And the trustee, like in any other trust, is there to operate in the best interest of the employee owners. Now, you as the selling owner, you don't answer to the trustee. But if all of a sudden you started making really ridiculous moves with your company, like buying Porsches for the secretaries, the trustee is going to say, is that in the best interest of the company? They have a fiduciary responsibility to act in the best interest of the company. We help you to find the right type of trustee that you're comfortable with. And, if 6 weeks after you work with the trustee, you're not comfortable, fire the trustee and bring in another one. So again, you don't have to put them on your board of directors, but they're there to make sure the company does what's in the best interest of the employee owners.
So you mentioned the fact that the owner would be able to distribute shares with discretion to various types of employees. Does the owner have the ability to allocate more shares to certain key employees who are going to be critical to the success of the company versus just the average worker bee?
That's an awesome question. I mean, as you know, Neil, because you set up a lot of them with a qualified plan, 401k profit sharing, you can't discriminate. Everybody's going to get the same formula. And because this is a qualified plan, it works the same way. But you have one other tool that you don't have with a qualified plan. And think of it as phantom stock options. They're called SARs, synthetic equity. And there's a percentage of the total shares available to distribute to those key people. And the difference between that and the other shares is every 5 to 10 years, based on how they're designed, they cash out. So cash is paid to those key employees, and then those shares regenerate and they're back in the pool to give to whoever you think needs them to act in the best interest of the company. So yes, there is a way to incent those people. When you're talking about how are the shares distributed, we work with the selling owner to say what may be the best thing. Is it going to be based on how much people make, how long they've been with the company? Is it maybe a combination of those things? We'll know how many shares there are to be distributed, over what period of time they're going to be distributed. So, we want to make sure the company is around also. In fact, obviously, as an ESOP, we were concerned about that with our organization. But if you look back, even during COVID, we never lost a single ESOP that we structured. We left a lot of room in all of our designs to make sure that if the unforeseen happens, the organization can remain in play. So we use about 65% of projected revenue in our designs. A lot of my competition will use 85 or 90. The numbers look better, but they don't leave a lot of room for error. And one thing we all know about business, nobody saw COVID coming. So we wouldn't be cocky enough to say we see what's coming next. But at least we know we have design.
Yeah, it's interesting. I know that you mentioned earlier that one of the advantages using an ESOP is that the seller has the ability to sell his company without capital gains. Are there any other tax advantages during the operating those intervening years for the business to engage in an ESOP?
Yeah, absolutely. Uh, there's one of the biggest advantages is that the federal government basically buys your company. That's a very simple way to do it. Once a company becomes an ESOP, an employee stock ownership program, it no longer has to pay state or federal income tax. Those tax savings are used to help pay off the owner. And most of our owners, Neil, are paid between 7 to 10 years, everything that's owed to them. So if we looked at what's the street value of a company, you could go get an analysis done of what the value of the company is. And we do the same thing. We say, what are the comps? What is other companies like that? What are the earnings? What's the EBITDA? What's the multiple? We do exactly the same thing. Ours are going to look a little bit better because we get to factor in the 5-year look forward or the 5-year projections of the company in that value. That is a factor. So if you think your company is going to be doing worse over the next 5 years, you're probably not a very good candidate for an ESOP. If your EBITDA is less than $1 million and you have less than roughly 20 full-time employees, you're not going to be a good candidate for this because we need to have enough people to be able to distribute the shares to, and it has to make economic sense. We're willing to take a look at where you're at and answer phone calls. We don't really want to get into a process either with you, waste your time or our time, but we can tell you on a confidential basis if it looks like you're a good fit. So we kind of take those steps as needed.
Yeah, that's very interesting. So beyond the minimum employees and minimum EBITDA, are there any other, I guess, industry sectors that are particularly ripe for an ESOP transition plan as opposed to?
Yeah, there are some. The trades are awesome. We do a lot of work with professional trades. Surgical centers are amazing. Individual physicians, a lot of states don't allow that. Some states do. So that's specific. Law firms, same way. Some law firms are not allowed to become an ESOP because it's basically spreading out their liabilities. Some are. So again, we want to kind of look at what type of company you are, what your structure is. Your corporate structure has a lot to do with those tax advantages, but those can be changed. And that's part of what we do. We go through all those advantages with your CFO or with you, your CEO, however you do all your finances. So, we can do a quick look and tell you if it's a fit. And if it is, then we start to go through the process.
Excellent. Well, ladies and gentlemen, we have just scratched the surface, but I wanted to give you at least a taste of what is possible using an ESOP. And as Brad mentioned, it carries tremendous tax benefits. It confers benefits to the business owners because they can still retain control of their company. They're not being managed by a 20-something working for a private equity firm, but they actually get to continue having a say in the company that they birthed and grew to maturity. So there are a number of reasons why an ESOP would possibly make sense for you. What I would encourage you to do, if you would like to know more information, reach out to me and we will be glad to set up a Zoom with you and walk you through essentially a get to know you visit and determine whether there's a there and whether an ESOP makes sense for you in your future. Thank you, ladies and gentlemen. Thank you, Brad.
Yeah, very good to see you again, Neil. And obviously, everything that we do, because of the nature, is we set up non-disclosure agreements. We don't want employees thinking something's going to happen if the owner chooses not to follow that path. So we can be as discretionary as the owner wants to be. That includes maybe using non-business emails if somebody has a tendency to look over yours. So we've seen it all over the years. All right, look forward to talking to you, Neil. Like everything else, look forward to seeing you again shortly. And pleasure speaking to your group.
Thank you, guys. Thank you, Brad.